Picture a man named Thomas. It is the spring of 1720, and he is a mercer, a cloth merchant, in the city of London. He is not a financier. He has never owned a share in anything. He does not know what a balance sheet is or how to read one. What he knows is that his neighbor solicitor bought shares in the South Sea Company in January at 128 and sold them in April at 330. And his neighbor told him this over a pint of porter at the coffee house and seemed barely able to believe his own luck. What he knows is that the lady who takes his wife's dresses is talking about South Sea stock at the Milliners. What he knows is that the pamphleteers who hawk their sheets at the Royal Exchange are writing about South American gold mines and Spanish treasure routes and the unlimited profits that will flow to England once trade opens fully with those territories. What he knows is that King George the Worms of Great Britain is himself a governor of the company, which means the Crown has staked its name on this enterprise. And what the Crown backs cannot surely fail. Thomas buys shares at 550s in May 1720. He borrows part of the purchase price, using the shares as collateral for the loan, as the company encourages investors to do. He does not know, because nobody told him, because the machinery of the scheme was specifically designed to prevent him from knowing, that John Blunt, the primary architect and director of the South Sea Company, had sold all his own shares in August, just before prices began to fall. He does not know that the Chancellor of the Exchequer, John Aislabie. What he knows, by December, is that he is ruined. The South Sea Bubble of 1720 is the founding document of financial regulation. It is the event that demonstrated for the first time in recorded financial history that a joint stock company could be constructed around a fiction, that its directors could sell the fiction to a public hungry for returns, bribe the government officials whose approval was required, lend investors money to buy the fictitious shares, use the proceeds to prop the price artificially, sell their own holdings at the peak while the fiction was still intact, and leave everyone else to discover the fiction when the price collapsed. It demonstrated that individual intelligence offered no protection. Sir Isaac Newton, the man who had calculated the orbits of planets and formulated the laws of motion and gravity, lost $20,000 in the South Sea Bubble, approximately $268 million in modern terms, according to the Bubble calm analysis, and said afterward that he could calculate the movement of stars, but not the madness of men. If Newton could not avoid it, Thomas the Mercer had no chance. To understand what made the scheme possible, you have to understand what Britain was trying to solve in 1711. When Robert Harley, the Tory Chancellor of the Exchequer, soon to become Earl of Oxford and Lord Treasurer, and John Blunt, a sharp-elbowed promoter who had been director of the Hollow Sword Blade Company, an unofficial bank, conceived the company that would eventually destroy Thomas's livelihood. Britain in 1711 was, like Britain in 1756 and 1793, and every other year in which it fought a major continental war, living beyond its tax revenues. The War of the Spanish Succession, which had been running since 1701, had accumulated a national debt of approximately $9 million in floating obligations, Army and Navy debentures, unpaid bills, short-term instruments that the government was struggling to service. The Bank of England, the natural lender to the government, was a Whig institution that the Tory Harley was politically unwilling to lean on. He needed an alternative. Blunt provided it. The mechanism they designed was an early version of what would later be called a debt-equity swap. Private investors, mostly wealthy merchants and speculators who held existing government debt obligations, would exchange those obligations for shares in a new company, the South Sea Company. The government would pay the company 6% interest per annum on the face value of the debt it had absorbed, which the company would pass on to shareholders as dividends. In exchange, the company would receive a monopoly on all British trade with the colonies of Spanish South America. As the Econlib account of the scheme records from its foundational analysis, the company was originated in 1711 with the view of restoring public credit and providing for the discharge of the Army and Navy debentures and other parts of the floating debt amounting to nearly 10 million sterling, with the government agreeing to secure them for a certain period, the interest of 6%. The initial debt conversion was $9.5 million. There was a practical problem with this scheme that was visible from the beginning. The monopoly on South American trade was essentially fictional. Spain and Portugal controlled the relevant territories. Britain was at war with Spain. The Treaty of Utrecht, signed in 1713 when the war ended, did provide the company with the asiento, a monopoly on supplying enslaved African people to the Spanish colonies, and the right to send one 500-ton trading vessel per year to Portobello and Veracruz for general merchandise. As the EBSCO Research Starters account documents directly, the company's actual trading profits never materialized, and the company never realized any significant profit from its monopoly. The one trading voyage the company sent in 1717 produced only moderate results. The company's income was, and remained, the guaranteed government interest payment on the debt it held. The South American trade was a story, not a business. It was a story that happened to be told in an era when most of the people who might have investigated it could not easily travel to South America to see for themselves, and when the government's public endorsement made questioning the story seem unpatriotic. For 8 years, from 1711 to 1719, this fraudulent premise sat relatively quietly under the respectable surface of a government-backed company paying steady dividends. The company made its money from government interest. Its shareholders were content with modest returns. The South American trade remained theoretical. And then, in 1719, John Blunt looked across the channel at what John Law was doing in France and decided to do the same thing in England at scale immediately. John Law was a Scottish economist, in exile from Scotland under a death sentence for killing a man in a duel, who had convinced the French government to allow him to implement a radical scheme. The Mississippi Company, which held the monopoly on French trade with Louisiana and the North American interior, would absorb the entire French national debt, exchanging it for company shares. Law was printing banknotes through the Banque Royale to lend to investors to buy Mississippi Company shares. The shares were rising. France was experiencing a speculative fever. Paris was full of Rue Quincampoix, the street where the Mississippi Company shares were traded. Stories of overnight fortunes. Money was flowing from London to Paris to participate. As the EBSCO Research Starters account records precisely, inspired by Law's example and afraid of English money flowing to France, Blunt and the South Sea Company's directors came up with a scheme similar to that of Law. In 1719, the South Sea directors proposed to absorb the entire English national debt, approximately $31 million in government bonds and long-term annuities, as the World Politics Substack analysis documents. The Bank of England made a competing bid. The South Sea Company outbid it, offering the government better terms. The competition between the two institutions for the privilege of absorbing the national debt was itself a mark of how distorted the incentives had become. Both institutions were offering to take on the government's liabilities because the scheme for profiting from the associated stock promotion was so lucrative that paying generously for the right to run it made financial sense. Parliament approved the South Sea Company's proposal in April 1720. The moment approval was announced, the promotion machine that Blunt had been running shifted into its highest gear. The price of South Sea shares had started January 1720 at 128.5. By February, it had reached 175s. In March, 330. In May, 550. The company was issuing new subscriptions, invitations to buy additional shares, at progressively higher prices, requiring only partial payment up front with the balance due in installments. As the Curiosity Harvard analysis documents, the company aggressively encouraged the purchase of shares through installment plans and loans. Blunt had instituted a program in which the company would lend investors money to purchase South Sea stock, using the stock itself as collateral. As shares rose in value, less stock was needed to support each unit of the national debt conversion, freeing up surplus shares that could be sold at increasingly higher prices. The company was in effect monetizing its own rising share price by issuing new shares against the surplus created by each price increase, lending the proceeds to investors to buy more shares, and using the resulting purchases to push the price higher still. It was a mechanism for converting collective credulity into cash, and it worked for precisely as long as the credulity lasted. The corruption that ran alongside the financial manipulation was staggering in its brazenness. As the Wikipedia article on the South Sea Company documents with specificity, the founders of the scheme engaged in insider trading, using their advanced knowledge of the timings of national debt consolidations to make large profits from purchasing debt in advance. Huge bribes were given to politicians to support the acts of Parliament necessary for the scheme. Company money was used to deal in its own shares, and selected individuals purchasing shares were given cash loans backed by those same shares to spend on purchasing more shares. The expectation of profits from trade with South America was talked up to encourage the public to purchase shares. As the World Politics Substack analysis documents from parliamentary inquiry records, ministers and government officials invested heavily in South Sea stock, and some received payments from the company in exchange for political support. The scheme had enriched government ministers and officials who had invested in the stock and benefited from access to privileged information. Outside the South Sea Company itself, the speculative mania generated hundreds of imitators in the spring and summer of 1720, joint stock companies promoting schemes of varying degrees of implausibility, each hoping to capture some of the investor enthusiasm that the South Sea Company had demonstrated was available. The EBSCO Research Starters account records some of the more celebrated examples. Companies for trading in hair, for extracting silver from lead, for building a wheel in perpetual motion. The World Politics Substack analysis adds one company established to extract oil from sunflower seeds and another proposing settlements in northern Canada. The most famous of all, recorded by every chronicler of the period, was a company incorporated as the prospectus described it, for carrying on an undertaking of great advantage, but nobody to know what it is, which sold shares at $100 each, with the promise of extraordinary returns from an investment whose nature the investors were not permitted to know. The company raised $2,000 in one morning, and its promoter was never seen again. Whether this story is precisely true or has been improved in the telling across 3 centuries of repetition is uncertain. What is certain is that the environment that produced it was entirely real. By the summer of 1720, the speculative mania in London had reached the point at which the absence of any stated purpose was apparently not by itself a deal-breaker. The South Sea Company itself had watched these imitators with alarm, not because they were fraudulent, but because they were competition for the same speculative capital. The company lobbied Parliament to pass the Bubble Act of June 9, 1720, which required parliamentary approval for the incorporation of joint stock companies and effectively froze out new competitors. The Privy Council followed on July 12th by dissolving the most egregious of the bubble companies. The irony documented in the Wikipedia article on the company is that the passage of the Bubble Act was promoted by the South Sea Company itself, the most fraudulent enterprise in the city, using the machinery of financial regulation to suppress its less powerful imitators. The Bubble Act paradoxically accelerated the crash. Investors in the suppressed bubble companies needed to sell those shares to raise cash, creating downward pressure on the broader market. And the uncertainty generated by the sudden dissolution of multiple companies created the first cracks in the general confidence that was sustaining South Sea prices. By August 1720, the shares had reached their peak of approximately $1,000. The level of selling was such that the price started to fall, and in August, the first installment payments on new subscriptions were due. Many shareholders could not pay for their shares except by selling them, creating a scramble for liquidity. The company's own directors had been sustaining the price by ordering their agents to buy shares when selling pressure appeared, but by August, the volume of selling exceeded the company's capacity to absorb it. The price began falling. John Blunt sold his entire personal holding in August, just before the most severe decline. As the EBSCO Research Starters account records precisely, Blunt sold all his South Sea stock just before prices began falling. He knew what was happening because he had built the mechanism that was now failing. He said nothing to the investors who were still buying at $800 and $900. By September, shares had fallen to approximately $400. By December, as Britannica records directly, shares were down to $124, an 88% decline from the August peak. The collapse triggered a chain of insolvencies. Investors who had borrowed to buy shares could not repay their loans. The goldsmiths and private bankers who had extended credit against South Sea shares as collateral found the collateral worth a fraction of the loans. Banks that had lent against the company's paper failed. The contagion spread internationally. The crash coincided with the collapse of John Law's Mississippi scheme in France, and, as the Harvard Curiosity Analysis documents a scramble for liquidity, appeared internationally as bubbles were also ending in Amsterdam and Paris. It was the first international stock market crash. The political reckoning was swift by the standards of the time. Parliament launched its inquiry in December 1720. The secretary of the South Sea Company, Robert Knight, who held the most detailed records of the company's bribery operations, a book known as the Green Book, fled to the continent in January 1721 before he could be arrested carrying that evidence with him. As the Econlib account of the parliamentary proceedings records, a motion was carried that the directors had been guilty of a notorious breach of trust, had occasioned much loss to great numbers of His Majesty's subjects, and had highly prejudiced the public credit, and it was ordered that they be expelled the house and taken into the custody of the Sergeant-at-Arms. John Aislabie, the Chancellor of the Exchequer, was expelled from Parliament and imprisoned in the Tower of London. The source of the detail recorded in multiple accounts that the Chancellor was briefly locked up in the Tower. The directors of the company were ordered to surrender their personal assets. As the Wikipedia article records, Blunt, Carswell, and Sawbridge together surrendered $65. Sir Jansen $25,000 of his own plus $250,000 from a foreign consortium, and numerous other directors surrendered substantial sums. The confiscated assets were used to compensate investors at a fraction of their losses. Robert Walpole, who had opposed the scheme from the beginning, who had sold his own South Sea shares before the peak, and who had been developing a reorganization plan since the collapse became apparent, emerged from the wreckage with his reputation intact and his political position strengthened. He became First Lord of the Treasury and Chancellor of the Exchequer in 1721, and is considered the first British Prime Minister, holding power until 1742. His reorganization plan transferred portions of South Sea debt to the Bank of England and the East India Company, stabilized the financial markets, and restored sufficient confidence for normal commerce to resume. The South Sea Company itself did not immediately collapse. It continued to operate for another century, trading mainly in government securities rather than South American commerce, until its remaining annuities were converted into government stock, and it was finally dissolved in 1853. The legal and regulatory consequences of the bubble were not, by modern standards, sweeping. The Bubble Act of 1720 restricted the formation of new joint stock companies, but did not establish any ongoing regulatory oversight of the companies that already existed. There were no disclosure requirements, no requirements to publish audited accounts, no rules against insider trading, no restrictions on lending against one's own shares. The mechanisms that Blunt had used, the installment subscriptions, the company loans against owned shares, the artificial price support through agent purchases, the distribution of shares to politicians in exchange for favorable legislation, remained legal. They remained legal for well over a century. British company law did not require published annual accounts until 1844. The London Stock Exchange did not adopt meaningful listing requirements until the 20th century. The South Sea Bubble happened at the founding moment of the joint stock company era, before anyone had built the regulatory infrastructure to constrain what company directors could do with investors' money. And the regulatory infrastructure built afterward was inadequate precisely because the people who built it were in many cases the same class of people who had benefited from the absence of regulation. Thomas the mercer lost his business. He was not alone. As the Royal Museum's Greenwich account states directly, a large number of people were ruined by the share collapse, and the national economy greatly reduced as a result. Jonathan Swift, the author of Gulliver's Travels, was himself a shareholder who lost money and wrote a savage satirical ballad on the subject. The rate of suicides rose noticeably in the months following the crash. The pamphleteers who had been celebrating the South Sea Company's prospects turned, with roughly equal enthusiasm, to denouncing it and its directors. What the South Sea Bubble teaches, 3 centuries after Thomas bought his shares at 550 and watched them fall to 124, is not a complicated lesson. It is simply that markets are not mechanisms for discovering truth. They are mechanisms for aggregating expectations, and expectations can be manipulated by people with sufficient access to capital, sufficient proximity to political decision makers, and sufficient willingness to profit from the credulity of others. The company that roped in King George I as its governor bribed the Chancellor, paid the king's mistresses, lent investors money to buy its own shares, and then sold those shares from the inside before the price fell, was not exploiting a weakness in the market. It was exploiting the market's fundamental architecture, the architecture in which the price itself is the primary signal that other investors read, and a rising price is therefore self-confirming, regardless of what underlies it right up until the moment it isn't. Isaac Newton lost $20,000 because he could not calculate the madness of men. Thomas the mercer lost his business because he trusted the price signal and the king's endorsement.